Quick question from Don. I'd like to trade a small group of highly liquid option credit spreads, 30 delta range, credit of around 20% or 20% return on the investment. Does this sound reasonable? And how might I approach this challenge using Power Options? Well, if the trades are there, the Power Options tools will find them. Further comments from Don. Liquid means 5 million shares on average per day, high open interest, several hundred contracts. Don says, can we approach this challenge? Well, I don't ever see it as a challenge. This is fairly easy. We're going to review it in just a couple minutes. In every search, you'll have a filter for delta that you can set up. You'll have a filter for open interest and option volume in the options category of the search tool. In the technicals, you always have the field for average stock volume. And if you wanted to go further with liquidity, you could go into the fundamentals and put in a market cap. Let's pause the screen real quick. We're going to change over to Power Options. Let's go ahead now and talk about creating a search for Don. First thing we want to do is we're just going to go into bull put credit spreads, and we're going to go into the search tool. This is how I access the patented search tool in any strategy on Power Options. Go into the search under the specific strategy. Once you click on the search screen, you'll see several listed trades that match one of our default criteria or the last saved search you're reviewing. So I scroll down below here and we have our default weekly bull puts. For Don, or if you have a search you want to create with several specifics, it's a very simple approach. Let's just hit clear filters. That empties everything out of the parameter fields down below. It's about 25 to 30 different option criteria, 20 or so stock technicals, 15 or so stock fundamentals. For now, let's just go to standard, May, expiration. Just make the changes here. Don wanted to look for a 20% minimum return. I'm not going to worry about strikes out of the money or probability. That goes sort of hand in hand with the delta that Don wants to look for. Something that I like to use, I'm going to put in a minimum option bid for the put that we'd be selling in our bull put credit and the put that we'd be buying of greater than 0. Short option delta. He wants to be less than 0.3 out of the money in case you're thinking of a call, so looking for a delta of 0.3 or less. In the bull puts, we have to think reverse. Puts have a negative delta. So we're going to look for a delta, short option delta of our sell option, that's the important one, of greater than negative 0.3, because technically negative 0.2 is a greater value than being negative 0.3. Requirements. Well, let's just put in a basic option volume today of 0 to show that it's traded, but we're going to put in an open interest of 500 contracts. Simple as can be. We've got our return, delta requirement, liquidity. Now let's go into the stock technicals. This is where we can take a look at the average stock volume. Now, if I hover over this or any filter in the parameter field, we get a pop-up definition. This one here, this is the daily volume for the underlying averaged over the last 90 days. This value is shown in thousands, excuse me. So if I put in an average stock volume of greater than 500, this would mean the average stock volume is 500,000 shares per day. Don wants 5 million, so we're going to put in 5,000 for the average stock volume. And if I wanted to, I could go into fundamentals. Market cap is measured in millions, but it shows here that a mid cap is considered 2,000 to 15,000, large cap 15,000 or greater. Let's just go mid to large. We'll go greater than 2,500. Right? Now we're going to scan the entire universe of optionable stocks for only those bull put credit spreads for May expiration that match those sort of 6 criteria that we just put in. And we narrowed it down to 316 results. That's still too many. But I see some things in here I might not be interested in. I don't know if Don is interested in them, but we've got some things that have pretty high volatility. GameStop, pretty big mover. Tilray's been moving. Earlier when I ran this search, I saw it also on Riot. And we have some ETFs in here, which might not be a bad idea, but there's probably some inverse 2 times and 3 times ETFs in there as well. Let's do that first. Let's go to lists, and let's just take out indexes and ETFs. Okay, so I'm going to exclude indexes and ETFs from our search. Let me submit that. Oh, sorry. Didn't mean to bump the microphone there. So now this is going to take some out of our list. We narrowed it down to 222 total bull put credit spreads for standard expiration. What is the other thing we know coming up where I probably wouldn't want to open a bear call or a bull put? Well, normally if I'm doing a bull put or bear call anyway, I'm using some different technicals here or fundamentals to look for stocks in an uptrend. If I'm doing a bull put credit spread, maybe a positive MACD, reverse for a bear call. But we're getting into an earnings cycle right now, and I don't want any surprises. So I'm going to go ahead and go to the fundamentals now and remove earnings dates between now and expiration. Just a simple checkbox here. Let's submit that. So we're going to go from 315 or so, 350 I think it was, down to 221, down to 46 total results. That's not bad. And you can now go through and start researching and analyze these positions. But again, as I mentioned, there's some things in here that I kind of don't like about the movement. GameStop, Airbnb, GameStop's in there twice. We can filter that out one of two ways. We could limit the implied volatility to look for more stable IV options, or even go back into the technicals and scan for historical IV, historical volatility. Limit the stock volatility. Let's just do that. I'm going to look only for stocks that have historical 50-day volatility, less than 50%. We put that in as 0.50. Okay, so we only have 3 now. ChargePoint Holdings, Bank of America. But again, what is one of the big things that's hindering this right now? That's the earnings date. Take that out. And we're going to have a reasonable number of screens now with popular names that you'd be familiar with that you were kind of looking for, Don. Facebook, Roblox, the new one, yes. Boeing, Las Vegas Sands, JD.com, MGM Resorts, JetBlue Airways, Marathon Petroleum, Chevron Texaco, GlaxoSmithKline. Okay, so those are probably all the names you were expecting to see. We only saw those 3, however, because I wanted to avoid earnings between now and expiration. Why take the risk of an extra surprise in a credit spread? So for bull puts, Don, that's the simplest path. Set your expiration date after you clear the filters. Screen by your short option delta. Just remember, in a bull put, you're looking for greater than negative 0.3. Put in your open interest to your desired measurement. I do like to use this option bid of greater than 0 as well. The average stock volume, we put into greater than 5,000, and then we decided to limit the volatility. Never hurts, by the way, to take out the indexes and ETFs so you don't see any 2 times bull, 2 times bear. At the same time, we did have the earnings date in there between now and expiration because I wanted to make sure to avoid that and avoid any surprises. For the bear call credit, you would do the exact same thing. But now in this case, Don, you just look for a short option delta of less than 0.3. And of course, you can toggle your expiration date if you want to look closer or lower the delta as well. But don't want to go too low on the delta expecting a 20% return. So here's the search results we have now that I've removed that earnings date between now and expiration. We see positions in here with 20, 29% return, and we have 58 total results, well within the range that you want. Now let's go further out of the money. We increase the delta to minus 0.20. This, of course, is still leaving the earnings date, and there's only 2. Because if I want to see more results, pushing that delta up to negative 0.2, pushing the probability to greater than 80 on high volume stocks with a lower volatility, we're going to be looking more at the 10 to 15% return range as opposed to the 20 to 25% return range. You had that with the 0.3 delta. The minute you push it up higher, you're going down lower in the return. You won't see as many in that case. You can play with those numbers, Don, to find the risk that matches your goals and your needs as well. Okay? All right, so that's how you do it for the credit spreads, Don, and the debit spreads as well. Use those basic criteria that we mentioned for the average stock volume, possibly the market cap. Make sure you avoid earnings between now and expiration. Might want to remove the indexes and ETFs as well. All right, going to some of our late or live questions. This is going to help me, and this is why I waited, Khokon, for this. The market sentiment tool just went to a bearish sell warning. I expected it to based on the market performance today. We were at a sell warning yesterday with 7 of the 13 indicators as bearish, and I think maybe 4 is neutral and 1 was bullish, or maybe somewhere along those lines. Maybe it was 5. In any case, this now has 8 of the indicators that have gone to a bearish sell. And we've talked recently about my trigger to start protecting positions based on the market sentiment tool, protecting my long stock positions, selling calls against my married puts that are up in price, buying insurance on covered calls, maybe to convert to a collar, adding protection maybe to my calendar spreads, or lightening up or not entering bull put credit spreads if I next cycle. When I see 2 of these in a row. So on Monday, I might start preparing for that. Why is this important? Khokon's question was, please explain using PowerOptions tools, if applicable, what is the preferred option strategy or strategies under the following circumstance? The market is overbought but continues to go up, and the underlying, like MSFT, is not showing much weakness. Well, I just sort of told you, Khokon. Earlier this week, let me go to the view here, overall sentiment. Earlier this week, you see the sell warning start to pop up. Okay, it was 7-5 and 1. That's what it was yesterday. And then it moved in the strong bearish sell warning today. When I see 2 of those in a row, that's when I start doing things. When the sell warnings were here, Khokon, I was still using power options as normal. In fact, April 14th here, 3 days of a sell warning. In this case, we actually opened a new married put position. I opened a married put position on Ally Financial. They actually had earnings today, and the earnings came out fairly well, and in the morning, but then they backed off later in the day. So we bought Ally at $47.95. Yeah, it's down after it went up a little bit, and the put's still right around the same price is perfectly fine. So I've sold calls against Berry Plastics. Probably going to sell a call against Masco. Right now, it's hitting up at 64.59. I actually have the 65 put on Masco in this case. Ritchie Brothers, we're going to look to add extra insurance on also. And Ally is brand new, so I'm not going to worry about it. The key is, Khokon, is I'm not changing much of anything right now. However, that being said, on Monday, I'm likely not going to open new bull put credit spreads for the weekly bull puts. What I am going to do is protect or close parts of the ones that are profitable here for the bull put credit spreads that I have open, and the calendar spreads as well. And if I see 2 or 3 bearish sells, then I may navigate more to bearish positions, Khokon. But right now, the focus to me is going to be on adding extra protection for the bullish positions, protecting the spread positions of my portfolio that have 100% risk. When I see more of a confirmed 2 or 3 bearish sells in a row, and the market starts to move, that's when I might start going and looking at some bear call credit spreads. I might start looking at other bearish strategies. But even up until today, I had a feeling this was going to turn, and it did. But even up to midweek, when we were seeing the sell warnings, I was still looking at bull put credit spreads, still holding my bull put credit spreads for today's expiration, those that expired. I added a new married put position. Now I'll look to adjust those that I have open. You have covered calls that are open. You see the sell warning. You might consider rolling down to a lower strike price to add more protection, buying a deep out of the money put to convert it to a collar. If you're in a naked put, you might consider closing some of those positions that have a profit. Again, if you see another bearish sell at the close of Monday and maybe the close of Tuesday. Probably close of Monday, I'd be doing it Tuesday morning if I hadn't done it already. Okay, so the goal is now to protect what I have, manage what I have in anticipation in the next maybe 5 days to 2 weeks, there's going to be a correction or a pullback, as the market sentiment usually indicates to us. Not going to worry about opening new positions in the bearish trend yet, Khokon, until that starts to trend downwards and starts to move in that direction. All right, so that's what we wanted to talk about there for Khokon. I'm sorry, we're going to go to the other live questions now. We showed this earlier a little bit, but this is for William. And I'm not going to try to group positions. We're just going to go in order as the, of course, live questions came in as well. Okay, let me just write this down. Okay, so I'm sorry, for William C. How do you close assigned positions in the portfolio? Also, do you adjust for unassigned covered calls? Okay. So yes, everything, we showed this a little bit earlier when we were doing the review on the long calls for Austin. Now, I don't have anything. It's April 16th. That's fine. Let's go back to I don't think I had anything in here. Let's try the new positions for March 12th. If I don't see anything right away, we'll just back out. Oh, there it is. Okay. So in this example, we bought Masco at 55 and sold the April 16th 55 call. All of the actions, William, recorded in the portfolio are through this more information button on the left-hand side. So as I go through today, and I'll close and adjust my positions in the radioactive trading and fusion portfolios sometime later this afternoon after the webinar ends, and some of my other positions, I'll do this too. Click the Edit More Information button, the blue button with the white arrow next to your position. Go to Position Actions, and you can see you have some edits here. But what you want to do for a covered call, or naked put, or part of a bull put credit spread, is click next to the option. Really, just for a covered call or a collar or a married put with a call sold against it. Click it on the option, William. Now this allows us to close the leg. If I was simulating buying to close my April 55 call, not rolling it, just buying to close it, that's what I would do there in that case. Position Actions, close leg. Roll leg. If I am going to buy back this 55 call for 960 and roll it up to a 65 strike, I'd use the roll leg feature. If I let it be assigned, I would choose Exercise Assign, and this would simulate having the shares of Masco called away from me at $55. Or in this case, if it expired, if the stock was below 55 and my call expired, I select Expire All Options. So if I decided to roll the leg, if I click on that, William, it takes me to a field here where it's showing me the buyback cost of the option right now in the database. If I closed it earlier today at a different price, we would just put that in. Then, okay, I'm going to roll it up to the May 65. Probably not for a credit, it'd be a debit. So I just select the option, select the expiration. The 65 strike there, it fills in my price, but let's say I got $1.75. So what this would do is simulate buying to close this in my portfolio and adjusting the cash on hand as necessary, and then selling the new May call, and I'd be able to see the new return and new analysis for that covered call roll position. But what I want to do is, I do want to do this. Okay, I'm going to do this. I wouldn't do this. I would let it be assigned, so I would have chose assignment on that position to make the maximum return. Now it shows me my Masco position. Cost originally $55. And I have a May 65 call open now that we collected at $175. But my effective cost per share has gone up to $63.10. Why? Because that's taking into account the premium I received plus buying the buyback cost of $960 or $930 that I put into the position. So my cost basis goes up $8.10. So now effectively I own shares of Masco at $63.10, and I have a May 65 call at $1.75. And anytime now you go to the profit and loss chart or the position analysis, William, that will take that into account. And that you have the cost basis of $63.10, your May 65 call at $175. So the max profit now is $365 or 5.9% if we get assigned at May expiration. It's taking all those calculations into account. Now, where is it? Where's my original call? The portfolio tools only track your open positions. So if you go into transactions, you can see the record of the realized gain or loss on the call we just closed to roll to the next strike. Or if you want to look analysis by symbol, shows me a running tab of everything I've done with Masco so far. Those highlighted in reddish pink are the ones that are still open. This one with no background is the call that was closed. So as I continue to roll and adjust positions in that case, we're going to keep seeing the record of it and a running total of what my profit is, realized or unrealized, in the analysis views here as well. Okay, so that's how you do it all. We don't assume that a position was assigned because you might have closed it before. Okay, we don't assume the weekend of expiration that any in-the-money options that are in someone's portfolio were automatically assigned or they expired. They might have closed them or rolled them early. We don't want to cause a problem. Use the More Information button, Position Actions. On a covered call, Mike, you got to click it next to the option. Click it next to the option. Go to Position Actions, Exercise Assign, Expire Leg, Expire All Options, Roll the leg, or Buy to close the leg in this case as well.